Right, let's make a start, shall we? Okay, good afternoon, everyone. Before we begin today's workshop, there's a few housekeeping matters. So please take note of the Okay, settle down, please. Okay, please take note of a few housekeeping matters for next week, okay? But it only applies to next week, okay? For those of you who normally goes to the 2 p.m. or 3 p.m. classes, tutorials, I mean, for next week only, the venue has been shifted to HD 3008. I think it's somewhere nearby, so okay, please note that just for next week. So that's for next Thursday. For the afternoon classes, I presume the evening classes are still okay. They're still in the same venue. Okay, so that's the first point. Second point is that for next Friday, I won't be having my office hours for next Friday because I'll be overseas. Actually, my plane leaves 2 hours after next week's class. So yeah. So that's just for next week. But of course, if you want to see me sometime earlier, then I'm happy to make an alternative time to see you. Okay, so that's the second comment. Now for the third and last comment, it's about the study guides, which I presume are relatively more important for the off-campus students. So for the past week, after last Thursday's class, being all inspired, I went and did redo all the study guides, so they are all updated and they are now fully synchronized with every single one of my workshops. So if we take, for example, okay, so if you take, for example, the study guide for today's workshop, I guess the two important things. What's going on? So I've written some outline and basic information on all the key details that we're looking at, but I guess the key, the important guides for your own revision will be the, I've included the sections that you need to read for the relevant chapters, okay? So if there's time constraint, you don't have to read the entire chapter. So for example, in today's class, 16.2, 16.4, 16.5. The reason why it jumps to 21.1 is because in the last 1/3 of today's workshop, we'll be looking at options. So that's why it jumps to a chapter on the basic mechanics of option contracts, call and put options, okay? But those are the specific sections of the relevant chapters. Tutorial questions are important. And I guess the other important thing, since I've already done this, that would help you, or should I say guide you, would be the specific learning objectives. So after going through the tutorial questions and after having a look at my suggested solutions, you should be able to put a tick to every single one of them, okay, or at least most of them. So this will give you a clearer map of what is it that you should pick up from each of my workshops. If it's still not clear from the tutorials and from doing the assignments, okay? So these are, what I'm showing you here is just for workshop 5. I've also updated workshops 1 to 4 and also next week's workshop as well. Okay, so hopefully this would, I don't know, enhance your learning experience. This is what we're trained to say to students, okay? So this is the, yeah, so the additional set of things for you, okay? Right, let's go back to the slides. Okay, so note this, the 3 pieces of information for next week. And I'll make an announcement on DSO soon enough as well, okay? Now for today's class, if I were to give you a verbal outline, there'll basically be 3 parts. Now for the first part, we'll try to finish off the 2 remaining channels for which a company can raise equity. So other than just an IPO, for an existing public company to raise additional equity capital. So last week, for roughly the second half of last week, we looked at rights issue, which is equity capital to be raised from existing shareholders. So for the first 1/3 of today's class, we'll look at the other common sources, the 2 other common sources, which are private placements. So that's the first one, and the second one is just a bit on it, will be on this thing called dividend reinvestment plan. So those are very common channels by which an existing public company raises capital. So we'll look at that for the first 1/3 of today's workshop. And then for the second one-third, what we'll do is we'll revisit this IPO process, the process of initial public offering, specifically focusing on the two important aspects to it. The first aspect is the lead up to a company floating its shares. This process called underwriting. So underwriting is the process of leading up to a company floating its shares on the stock exchange. And the second part of it is this phenomena that is called IPO underpricing. So the two aspects of an IPO process, underwriting and underpricing. Underpricing is something that we observe on the first day of trading. So what are those two aspects, and how could they possibly be related to one another? Okay, so that's the second one-third. And for the last one-third, it's just looking at the basic mechanics of call and put options, which I need to discuss warrants, and indeed, I need that for next week's class as well. I'm not sure what's the extent in which call and put options are covered in your prerequisite, but I'll make sure that you at least have the basic mechanics to satisfy what I need you to do for next week as well. Okay, so it's one-third, and one-third for today's class. Okay, and these are all outlined in the the list of learning objectives in the study guide as well. Okay, so try to make use of it. I was working through up to Saturday at 10 p.m. in my office, and before I realized, oh shucks, I missed my daily dosage of Iron Chef. So all this sacrifice that I made, make sure you use it. Okay. Strange thing happened on Saturday. I was a bit scared because there's a bunch of students, I hope not, skateboarding. So that was a bit weird, but anyway. Okay, with private placement, so it's as the name, I'll go straight to the name of what it means. Okay, private placement. It's the placement of new shares privately with normally institutional investors, and those are normally new institutional investors or fund managers or pension funds. So you approach a group of large institutional investors who are not existing shareholders, and you say to them, I need to raise some equity capital within a short period of time. Would you like to buy some new shares for my company at a discount? Okay, so that's, as the name implies, that's what we mean by a private placement. It sounds like a rights issue in that new shares are being issued at a discount. And I guess the key difference is it is often made to new shareholders. So not to existing shareholders, but to new shareholders. That's the first point. Second point, normally those new shareholders that are being approached are institutional investors. So fund managers, pension funds, etc., etc. Okay? And the reason why private placement is part of the story in terms of the list of potential sources by which an existing company can raise equity capital is because private placements are much quicker. There's less regulations associated with rights issues. The time is quicker. You may not need a prospectus. You directly go to a small group of investors and say to them, would you like to buy some new shares at a discount? And the main reason why private placement is part of that list of channels of sources of capital is because of the timing. Because you see, sometimes companies may need to raise funds within a short period of time. For example, a commercial building developer. So if you happen to stumble across a piece of land and it's due for auction in 2 months' time, if you do a rights issue, you miss the auction. So you need to raise funds quickly. So the private placement channel gives you that flexibility to raise normally a smaller amount of fund, but very quickly, for you to go bid for a piece of land, buy out a foreclosed property, etc., etc. Okay, so that's why private placement is is within that list as well. And indeed, because new shares are being issued at a discount, like rights issue, so with private placement, it would also trigger a subsequent dilution of existing share price. Okay, because the company is issuing new shares but taking in funds less than what they're worth in the market. So you're taking in less than proportionate. So that's why there's a dilution going on. If you're still not clear on this from the rights issue, we'll do a numerical example to show it once and for all. Okay? But so that's the key difference between private placements and rights issue. It's always you need funds within a shorter period of time. The amount is normally smaller, but you need it quickly. So you approach new institutional investors and ask them to buy shares in a company at a discount. Again, illogical to say premium. Would you like to buy some shares at $12? They're now worth 10 in the market. It's a silly statement to make. Okay, so you need to entice them with some sort of discount for a private placement. Okay? Now, with what we discussed on rights issue last week, we talk about the reason why is it that in terms of the mechanics, there'll be a dilution on the existing share price, but in terms of the implications, the wealth and voting rights implication of existing shareholders, we've also said that, okay, if rights issue is being made at more discounting, that means that the dilution that's going to happen will be even more severe. The more heavily the rights issue is being made at, the more the subsequent dilution in share price. So we sort of went through that last week. But I've also said that the level of discounting, the degree of discounting for the rights issue, and hence the amount of dilution, that by itself shouldn't matter to existing shareholders, provided, let's do a quick revision, anybody who didn't walk out last week, provided shareholders do what? To protect against wealth dilution. That's right. Either if we participate in the rights ourselves, we get the benefit, so that will compensate us for the subsequent dilution, or if for whatever reason we choose not to participate in the rights issue ourselves, we will renounce it, we sell off the rights themselves to third parties. So either way, it will compensate us for the subsequent dilution in the share price from the rights issue. Now, so that's the statement that you make for to counter against wealth dilution. But as far as voting rights are concerned, if you fully participate in the rights issue, you can imagine if you're all existing shareholders, new shares are being given to you as a proportion to your existing holding. So you can imagine that across the entire population of existing shareholders, your ownership percentage all shift up proportionately. Sorry, the number of shares shift up proportionately, but in terms of percentages, they remain the same. So if all existing shareholders fully participate in the rights issue, there'll be no impact, no change in terms of percentage of ownership, hence voting rights. But if you actually choose to renounce your rights to third parties, for sure, you get the compensation, but you do not get new shares, which means that your percentage ownership might drop. Now, for most investors who are minor shareholders like myself, it doesn't really matter because we don't normally attend the meetings anyway. But for the large shareholders, this comes into play, the larger shareholders. Okay, if I renounce them, my percentage ownership might drop. So if I'm keen on having a say in terms of the key decision making of the company, then I lose out on the voting rights in that sense. Okay, so that's that issue there. But with private placement, it is quite severe because this benefit is being made to potentially new shareholders. So existing shareholders would suffer from the dilution and the dilution of both wealth and voting rights. Okay, so because it's only being made to new investors, existing shareholders couldn't do anything about it. Okay, so that's the difference between them. Now, so the question beckons, why on earth would any existing shareholder approve a private placement? Why would a private placement even exist? Wouldn't the board of directors say, okay, this is a no-no because existing shareholders will have a wealth loss as a result of the dilution. We have to cut this off completely. It cannot possibly exist. Why wouldn't existing shareholders say that? Revolt and things like that. Any thoughts, anyone?
Could it be that if the business is in such need of cash that the private placement adds value to the company beyond that business model?
Exactly. Because you see that flexibility, if it's all about having enough money to auction for that piece of land, which then becomes a good positive NPV project, what should happen to the subsequent share price? Increase. And isn't that what part of the process is? To enhance shareholder value. So even if it's a dilution mechanically, but if the information effect that is associated with this private placement, a very good project that needs funding, which is otherwise gone, then existing shareholders would say, okay, so be it, let's do it. Because they're going to get that information. They're going to have that positive wealth impact in terms of if everything goes well with the project, the value will flow through into increased share price over and above the initial dilution. Okay, but information effect is something that I didn't formally discuss last week. But for something to actually appear to be disadvantageous to existing shareholders, but for it to still exist and be a pretty common channel for raising funds, there must be some other reasoning behind it. Okay, so yeah, so that's the main argument for it. Okay, so that's why private placement is not something that is just for show. it is part of the process. It gives you that flexibility to raise funds as and when you need it, okay, which is important for running a business. So a quick example to see this thing with calculation to show the share price will fall. It's one of those things where if you see it, it's very straightforward, very simple. But if you don't see it, you're sort of wondering, you take in less than share price worth, number of shares. So let's do one last example to try to get that over and done with. Okay, so these are the details. So let's do some simple calculation. Okay, so existing before the private placement, these are the details. 10 million shares outstanding, share price $10. So the worth of the company would simply be 100 million. Okay, so 100 million, $10 per share, 10 million shares. Okay, so those are the details. Okay. 10 million shares outstanding, $10 per share gives me the value, at least the market value of equity at 100 million. Okay, so that's what's happening before the private placement. And in terms of the percentage ownership by existing shareholders, it's 100%. Okay, so they own the entire company. Okay, so percentage. So what happens post? So when we placed 1 million shares to try to raise $8 million, that means that we're placing shares at $8 per share. Okay, we're privately placing new shares at $8 per share, which means it's a 20% discount on $10. Okay, so at $8. So what would actually happen to the share price as a result of this private placement? Okay, I'll skip the M here because, I mean, if it's million at the top, million at the bottom, those two cancel out, okay? So we can just work with the actual numbers. So at the top, the company takes in 8 million, so you raise new equity of 8 million that goes into the company. But at the denominator, you issue out 1 million new shares, so 10 plus 1. Okay, and this, even without a calculator, you know that it must be a number less than 10. Okay, and I've also mentioned this last week. If let's assume unrealistically that we managed to privately place new shares at $10 per share. Now you know that if you issue new shares at $10, if the current market price is $10, then the share price will remain at $10. What simply happens is this number at the top is 10 instead of 8. So what you have is a 110 at the top, 11 at the bottom. So 110 divided by 11 gives you 10. Okay, so it's very simple plus minus divide calculation. Okay, so the wealth, the share price dilution comes in because you're taking in less than what the shares are worth in the market. Okay, so that's what caused it to dilute. Okay, so that's the second point. And in terms of your percentage ownership, instead of owning 10 out of 10 million shares before, collectively among all existing shareholders, now existing shareholders, they still own 10 million shares collectively, but the total number of shares outstanding is now 11. So it's about I'm hopeless with numbers. Slightly more than 90%, I would think. Yeah, 90.1%. Okay, so this is about 91%. So your percentage ownership drops from 100 to 90.1%. Okay, so that's the story. Yeah, so that's the key set of events in terms of what's happening in terms of the details. And the new shareholders' ownership will be 1/11, so you can also calculate what that is in terms of a decimal. But in terms of the total worth, it would simply be 1 million multiplied by the share price, the diluted share price, which is 9.818. Now, normally a standard, a basic evaluation of a private placement is to then say, okay, there is a wealth transfer because existing shareholders lose out, new shareholders benefit because they are able to buy new shares at a discount of the current market price. So normally we like to have a feel for, okay, what is the amount of the wealth dilution that we're talking about? Because the existing investors have their share price fallen, the share price have fallen, so they have a wealth loss, and new shareholders are able to buy new shares at a discount, so they have a wealth gain. So what is the amount of the wealth transfer from existing to new shareholders? Well, you can look at it from either the existing shareholder side or the new shareholder side, depending on which makes more sense to you. But for me, I normally look at it from the existing shareholders' perspective. So you see, for every existing shareholder, the share price has fallen from 10 to 9.818. So on a per share basis, the change is actually 0.182 per share. Okay, so for an existing shareholder that's holding on to one share, this is the wealth loss per share. And all we need to do to look at the collective size of the transfer is to multiply this by the number of existing shares, which is which is 10 million. So for each existing share, the fall is 0.182. So collectively, among the 10 million existing shareholders, is 1.82 million. Okay, so this is the 1.82 million wealth transfer that we're talking about between existing and new shareholders. Okay. Yeah. So that's the very basic analysis of the impact of a private placement between when we compare for existing shareholder pre and post, and also the wealth transfer between existing and also new shareholders. Okay. And if you want to tie it up with a picture, it's also pretty simple, because we know that after the dust have settled, the diluted share price is $9.818. So from existing shareholders' perspective, it's going from 10 to 9.818. But from new shareholders' perspective, they are able to buy each new share at a discounted price of $8. So from their perspective, it's going from 8 to 9.818. And for existing shareholders, it's from 10 down to 9.818. Okay, so that's the story that's going on a per share basis. Of course, if you want the total amount, you have to scale by the total number of existing shares, and for this one, the total number of new shares. Okay, but in terms of the picture, this is what I see, which is the same with this calculation. Okay, so depending on whether you want to look at it on an aggregate basis or on a per share basis. Okay, but get a feel for the numbers. Okay. So this is the quite a basic calculation to analyze the outcome of a private placement. But try to keep in mind, okay, the key difference between rights issue and private placement is with rights issue, existing shareholders are able to do something about it, whereas with private placement, they are not able to do something about it. But if we then bring in, all those information effects that are, okay, the money raised is for this good project, increase in share price, etc., so it sort of balances out the argument. Okay. Right, the last common channel by which companies can raise funds is this program that's called a dividend reinvestment plan. Okay, so dividend reinvestment plan is quite a popular program among Australian companies. Now, you won't fully understand the reason why it's popular until you do something like a dividend policy type dilemma or trade-off, which you are going to do in the later half of this trimester. Because you see, from a company's perspective, dividend policy involves a balance as well. Dividend policy is part of the mechanism to make existing shareholders happy. Okay, so you want to say to them, okay, we're doing well, that's why we're able to pay you dividends on one hand. But on the other hand, if you, from a company's perspective, to actually pay out dividends to shareholders, it's not always a good thing. What is the simplest explanation you can think of for that? Why would I say that? Why would a company be reluctant to pay out dividends to shareholders? I mean, isn't it about showing them that, oh, we're making all the money, so take your dividend? There's this dilemma that if we pay it out to existing shareholders, it creates it eats up on our cash flow, and if it eats up on our cash flow, it may give us problem in terms of not being able to take on all good positive NPV projects. If part of our cash flows has to be distributed to shareholders as dividends, so we may have to subsequently give up good existing projects. So there's always this trade-off between, you want to give shareholders some dividends to show that all things are good, so more shareholders would, so existing shareholders or whether potential new shareholders will buy shares in a company. But on the other hand, you don't want to pay out too much dividend, because if you pay out too much dividend, you couldn't take on all the projects that you could, which means that the future capital gains of your company would be diluted, so to speak. Okay, so there's this dilemma between giving too much and giving too little. So that's dividend policy in its simplest, most intuitive form. Okay, it's a lot more abstract than that, but the way that I say it is almost trivializing it. But that's the dilemma. You see, with if I were to give you two contrasts, it would be between mining stocks and banking stocks. See, with banking stocks, cash flow is not a problem, because the majority of their assets are dominated by loans, and with loans, the repayments, they come in on a very regular basis. So cash flow is never a problem for banks, but cash flow could be a problem for mining companies, because a lot of their cash flows are tied up in capital-intensive equipments. So that's why from mining companies' perspective, even though it has a lot of cash flow, the dividend payout is substantially lower than that of banks. If we look at mining resource sector and banking sector, the dividend payouts is quite different. But then again, with mining companies, because a lot of the funds are being reinvested into projects, the capital gains of mining companies are huge. Okay, so there's this. So it's back to this dilemma between yes and no. But dividend reinvestment plan is being introduced as a sort of balance between this trade-off. So what it basically involves is that, okay, we got all these profits that we've made from past projects, from past and existing projects, but instead of paying out the cash flows to shareholders as dividends, we pay them out to existing shareholders as new shares. So if we pay them out to existing shareholders as new shares, the existing shareholders are satisfied because they get those new shares as a form of dividend, because those new shares have value, and if they want, they can actually sell some of those new shares. So from the shareholders' perspective, they are satisfied because of that. But from the company's perspective, it allows them to satisfy shareholders, and at the same time, without having a drain on their cash flow, they can then use the cash flow to invest in new projects. So it's a means of having it both ways. So you give out return to existing shareholders, but you don't pay them cash, you give them new shares. So it's sort of like issuing new shares as well, but to existing shareholders as a dividend reinvestment plan. Now, there's another important aspect of this program that makes it appealing, is this releasing of franking credits. But again, this is one of those where if you teach a program like this where you don't know what's the background of students, you can't talk freely in terms of, okay, that you all know what franking credits are and what's the dividend imputation tax system. So if I were to give you a 30-second outline of what the dividend imputation tax system is, what it basically says is that if I, as the company, pays company tax, those company tax could actually become beneficial to shareholders. If I then paid out the after company tax profit as dividends, the corresponding company tax that I pay becomes a benefit to shareholders. So it's like a prepaid tax on your behalf. So that prepaid tax is called franking credits. And this is all under the system of dividend imputation. Okay, so that's the first comment. And basically what it does is that if companies choose not to pay out dividends because they need to lock in the cash flows to reinvest in projects, not only are they locking in the cash flows, but they are also locking in those franking credits. So a company pays all this money to shareholders, to the tax office, but it stays with the tax office. Shareholders cannot get it as a credit. But if I'm able to somehow pay dividends to shareholders, not as cash, but as new shares, not only do the shareholders get the franking credits, not only do they get the dividends as new shares, but I as the company am able to release those franking credits and pass them on to shareholders as well from the tax office. Okay, so that's why this is a program that frees up the, not just solve the cash flow concern of the company, but it also frees up the franking credits, which will hopefully benefit shareholders as well. So dividend reinvestment plan is designed for that purpose, to sort of indirectly raise equity, but how it does it is by retaining the earnings of the company. And instead of paying cash, we pay new shares. Okay? So that's dividend reinvestment plan.
Sorry, if the company paid out a dividend in subsequent years and it had paid tax in the previous year
Yeah.
and not paid dividend, would
Yeah.
it then fully frank?
Yeah, you could.
But would the franking credits apply? Would the franking credits have been generated from the tax paid in the previous year?
Oh, this from the company's perspective, a company tax accountant would be able to answer that, but I don't know what's the maturity, whether there's any maturity date constraints on those franking credits, but as far as I know, there isn't any. But one of the problems with a lot of our mining companies is that they make tons of money, hence the super profit tax, but because of their dividend policy of low payout, because they need to reinvest in their mining projects, they have a lot of franking credits in their accounts that they couldn't release to shareholders. So that's one of the issues that's being discussed in terms of, is there another way to release those to shareholders? Otherwise, they just go to the tax office. Okay. Yeah. So that's so dividend reinvestment plan, private placement, and rights issue are the three common channels by which Australian companies use to raise, existing public companies use to raise capital. Okay, so that's so hopefully you would have a sense of, okay, you've heard of this before, etc., and all those things. Okay. Now the next 1/3 of today's class is where we move to this, we revisit this IPO initial public offering, but specifically focusing on the two parts of it that are important. Okay, the lead up to the company floating its shares. So this underwriting process, and indeed the other part of it is the underpricing once the company's shares is traded on the stock market. See, underwriting from the investment bank's perspective is a very important part of their business. So one of the tasks that the investment bank does other than funds management, brokerage, market making is at the corporate side of things is underpricing. Sorry, not underpricing, underwriting. Okay, underwriting, the activity is very important. So what actually is underwriting process? It doesn't just apply, it mainly applies to IPOs, but it could also apply to rights issues and even private placements. So if if existing public companies want to ensure that their subsequent equity capital raising is successful, they will employ underwriters to guarantee that. So I guess the most basic question to ask is, what actually is the role of an underwriter in the process of IPO? So the basic answer to that is it actually guarantees that the amount of money to be raised is actually raised. You see, let's talk about it in the context of an IPO. Okay, so you get a sense of the value, the worth of your company from the point of view of the entrepreneur, and then you make a decision on the number of shares you want to issue. That will automatically translate into the price per share that you wish to float your shares at. Now, it could be the case that, okay, if you choose to float this number of shares at this price to raise this amount of money, it may not be fully subscribed. It could only be 60 or 70% subscribed. So in that case, if the amount of money that you need to raise falls short of what you actually raise when the shares are floated, you have a shortfall. So under this scenario, if your IPO is underwritten, what happens is the underwriter steps in, and for those shares that are unsubscribed or that are not being subscribed, the underwriter would mop up the excess supply. It would take up the rest of the issue at whatever the offer price is being made at. Okay, so the underwriter takes up any excess supply, any unsubscribed shares at the issue price if needed. Okay, so that would ensure that the company, from the new company's perspective, you would always be able to raise the amount of money that you set out to raise in the first place. Okay, so that's the basic relationship between the underwriter and the entrepreneur. Okay, in the IPO process, it guarantees that you'll be able to raise this money. But you see, the relationship between, or rather the economic role of the underwriter runs a lot deeper than that. And to fully see this, and indeed this is not something that most textbooks actually cover, because this is at the level of journal articles, but hopefully if I then discuss to you this other phenomena, which is underpricing, you get a better feel for this whole process of underwriting and underpricing, okay, which is what you don't normally get from most standard textbooks. Okay. But at a basic level, the principal role of the underwriter is to guarantee that the amount of money that needs to be raised is raised successfully. Okay, so that's the first point. Now, in terms of the to get deeper insights into the important role that is being played by investment banks as IPO underwriters, you need to first of all understand this thing called underpricing. Okay, so I'll now talk a bit about underpricing, and then you can, once you get a sense of what underpricing basically is about, you'll be able to see those two things side by side against each other. So I'll go straight to this simple calculation. It's just taking a reference point between whatever the price it is that the company is being floated at, so the offer price, subscription price, or issue price, whichever you want to call it. Okay, so that's the first number. And the other number, the other important number that it is being compared against is what actually is the price as being decided by the stock market, by the investment community. So how did the stock actually do, say for example, on the first day of trading? Okay, so that's the closing price, the first day closing price, and we compare between those two numbers to get a sense of the degree of mispricing. See, if you float your company at $8, so I'll run a simple numerical example. You, as an entrepreneur, you decide to float your company at $8 per share. Okay, so it's $8 per share. And on the first day of trading, if on the close of trading on the first day, your shares closed at $10 per share. So based on this number, you know that the percentage of underpricing is 25%. Okay, 2 over 8 gives you 25%. Okay, so that's the degree of underpricing. And just as a side note, in case you're wondering, some of the students actually did a subject that looks at all this, it's an investment capital market subject. So I think that subject might have covered a bit of what we're covering here, but not the part on underpricing and underwriting. But so we'll look at that soon enough, okay? But in terms of the mechanics of it, if the offer price is 8, if your shares ended up on the first day of trading closing at $10, that means that the degree of underpricing is 25%. If we choose to use the first day of trading as the benchmark price, as an indicator of what the market perceives our company is worth. Now, it doesn't have to be the first day of trading. You could always use a series of different measures. I mean, say the simple average on the first week of trading. So you take 5 numbers, first 10 trading days. Okay, that's another example. So you can play around with the horizon, the number of observations. The other thing that you could normally play around is instead of taking a simple average price, you could also take some sort of weighted average price. So this thing that the practitioners often quote, so if you hear this in any article, this reference price that they call VWAP. VWAP is something that we'll talk about next week, but I don't need you to calculate this, but just a sense of what it actually is. It stands for volume weighted average price. So what it does is that, okay, instead of taking the average price across 5 trading days, we acknowledge the fact that the prices that are associated with heavy trading volume should deserve more attention, because those are the prices that are actually caused by investors doing a lot of buying and selling. So those prices deserve a lot more attention than another day's price where there's only 2 or 3 trades. So this idea of VWAP is to pay more attention to prices that are formed as a result of a lot of trading during that particular day. Okay, so VWAP is a very commonly used measure of average price. It's a volume weighted average price. Okay, so that's VWAP. But whether it is the first day trading, the simple average, or some volume weighted average price, the point is, in terms of getting a sense of the mispricing, it is taking some reference of the price as valued by the market against our offer price. Okay, so that's, so in this sense, underpricing, with this example, the way that I define it is the market's perception of price is the first term, and the offer price is the second term, is minus here. So if it's, so I call it underpriced, which means that if this percentage is positive, that means that it's underpriced, because the offer price is being set below what the market perceives the company is worth. Okay, so it's being set below, hence it's being underpriced. Of course, if you do a calculation for another company, and if your underpriced percentage is negative, that simply means that your offer price is being set above the first day's trading price, which is why you have a negative number. So negative underpriced means it's overpriced. Okay, so this is just the definition of how this is calculated. But just so you know, the term IPO underpricing refers to the case where the offer price is being set below whatever measure we use to determine the market's valuation of our company. Okay, the offer price is always being set below it. So the phrase underpricing means the offer price is being set below. Okay, so that's the terminology out of the way. Now, here's the important thing. I think a lot of students can say, oh, IPO underpricing. Oh, I know that. Okay, so offer price is always set below, etc., etc. But if you then ask student, even if it's a third year finance student, you ask them, what is this IPO underpricing puzzle? You ask them to explain the puzzle, I bet you at least half of them wouldn't know how to describe it to you. Why is it a puzzle? They can explain IPO underpricing, but they fall short to be able to explain why is it a puzzle. See, if we take this example, and I've written some notes here so you can read for yourself, but this is the thought process, okay? If you look at this number and you say, okay, whether or not it is underpriced or overpriced is one thing, but we're trying to get a measure of mispricing, so misalignment between what the entrepreneur sitting down with the underwriter to say, okay, how much should we float our shares at? That's one number, the offer price. Now, the other number is determined by the stock market. So those two numbers come together, give us this measure of mispricing. But you see, those two numbers come from different sources. One source comes from the entrepreneur and the underwriter, deciding between themselves what price to float the company's shares at, on one hand. On the other hand, some price that the market decides. Now, it could be that the market has a very good day, so the first day closing price is very high. It doesn't mean that our offer price is low, it just means that the first day's price is too high. So you see, because those two numbers come from different sources, you would always have a misalignment between the two. You never have one exactly of even come close to the other. You would always have a discrepancy. But that in itself is not a puzzle. Have a think about the following. Okay, if you look at one case, take this example of that I've made up. Okay, $10, or we float at $8, is worth $10 based on the first day of trading. So, okay, in this case, it's 25% underpriced. But imagine if you are trying to analyze this, not just for one company, not just for 10 companies, but for hundreds and thousands of companies over the past 10 years, not just for one country, but for many different countries all over the world. So you have tens of thousands of IPOs. And you try to get a sense of, okay, what is the degree of mispricing for each IPO, of each underwriter, of each stock market, of each country. And when you aggregate them up, if it's just some problem in terms of misvaluation between two different sets of numbers, but over a very, very large sample, what should be the answer if you add up all those errors? Over time, a long period of time, many different cases, many different countries, what should be the final answer? Or what is your feeling as to what the final answer should be? If it's meant to be just some mispricing because one number is too short, the other number is too long, or vice versa. Very good. Over a long period of time, a large sample, you would expect those errors to add up to a number, not exactly zero, but it should be a number that is not very big. It should be a number that's close to zero. If it's meant to be errors, those errors should aggregate and wash out one another, isn't it? Sometimes we got it wrong above, sometimes we got it wrong below. Sometimes the market got it wrong above, sometimes below. But if your sample is large enough, if you aggregate up all the errors, they should add up to give you a number close to zero. or it should be a very small number. It shouldn't be very big. It should be very small. Now, this IPO phenomena, underpricing phenomena, it is called a puzzle because those numbers, when you aggregate across over a long period of time, over many for IPOs, over many underwriters, over many countries, they don't add up to zero. It is systematically wrong, but not just that, it is wrong on one side of the equation. See, when we talk about errors, we talk about magnitude and we talk about direction. The bias is always on the downside. In other words, the offer price for most cases is always set below what the market perceives is worth. And it is very systematic. It is very robust over time across countries. And what the IPO underpricing puzzle is about is this. See, if it's really about mistakes and miscalculations and misvaluations, then this thing shouldn't be there. The fact that this underpricing persists, there must be some explanation that's causing all this thing, that's causing this underpricing that's in the data. And so what researchers would then do is to try to find explanations for why is it underpriced? I mean, if it's underpriced, people would always buy IPO, so it should disappear. Why didn't it disappear? That's the puzzle. So that's the IPO underpricing puzzle. The fact that it is systematically biased on one side and it doesn't disappear. So if it doesn't disappear, there must be some good, sound explanation to justify its existence. And that is the IPO underpricing puzzle. Okay, so that's something that you may not pick up from the book, or you may not get it from other classes, but I'm trying to show that to you. You have to understand why is it a puzzle, then you can appreciate the explanations for it. Okay, so that's the so-called IPO underpricing puzzle. If you want to have a look at a sense of some numbers in terms of the degree of underpricing, the textbook has a nice diagram that actually shows this to you. Page 420, chapter 16, figure 16.3. Okay, so have a look at the degree of, you see all those percentages of mispricing, they are all under. They all represent cases where the offer price is being issued below the market's value of the company. Of course, the degree of the underpricing varies from country to country, but they are all on the downside. They are all being underpriced. Okay. Now, if I give you this fictional example, and Commonwealth Bank of Australia was in the headline for the last 2 days, so that's the bank that I'll use. If you imagine quite a number of years ago when if the Commonwealth Bank of Australia floated on the ASX, and given the history of underpricing for Australian IPOs is between 5 to 18%, if I were to tell you that CBA floated with an underpricing of 7%, okay, it's one of the top 4 banks here. Everybody knows it. We may or may not hold shares in the company, but we all know what it's about. If I tell you that the history of underpricing with Australian IPOs is between 5 to 18%, and if you see that CBA is being floated at 7% underpricing, what is that actually telling you in terms of any, is there anything you can infer from this story here? Now don't say things like, oh, it's at the low end. Yeah, we know it's on the low end. But what could you actually say? Is it a good response or is it a... But it's, if it's being offered at very low, then it shouldn't be just a 7% underpricing. It should at least be in line with the average here. I'm sort of more talking about what is it telling you. What is one interpretation to say that, or maybe the market is not really that hype on this particular issue, given that the history, the average is about 10 to 12%. Given that this is below average, it's not really that performing that well on par. Given the degree of underpricing is not as severe as what it's supposed to be, which means that the market is not really that keen on this. That could be one interpretation. Because you see, if it's about a company that's not really doing that well in terms of the marketing to try to get it known, then the underpricing will be quite modest. But then again, we're talking about one of the major banks here. So that can't be an explanation. So another explanation, and indeed one of the things that we look at in terms of investments, is to say that, okay, if the the recent history of underpricing, if it suddenly drops, what it's saying is that the overall investment community, the appetite for investment is not that great, especially if the IPOs are for companies that are quite well known. It could be saying that the investment sentiment of the stock market itself is not that good. Okay, so that's one way of interpreting it. The other interpretation is that if it's modestly underpriced, it could be a not that well-known company, a small company. But I mean, we're talking about one of the 4 major banks, then it can't be that explanation. So it could be saying something that is more macro, at a more macro level. And the reason why I want to get you to have a think about it is to finish up the last example. Now, the last week I mentioned a bit about, if it's this week, it will be 4 weeks ago, the Agricultural Bank of China debuted in Shanghai. So that's one of the largest IPO in recent history. Now, I want to ask 2 questions, so to give you a sense, and you then take this example to get a thing about what's the current global investment sentiment, okay? I want to ask 2 very simple questions. Number 1, anybody got any sense of the degree of underpricing in China for the past 10 years on average with IPO? That's my first question. Number 2, when the Agricultural Bank of China debuted 4 weeks ago in Shanghai, what's the level of underpricing? So I want 2 percentages basically. Anybody know? We've got quite a few students from, you didn't follow the news? With China IPOs for the past 10 years, the average underpricing is this number. The Agricultural Bank of China, when it floated in Shanghai 4 weeks ago, is this percentage. We're talking about one of the first top 4 banks in China floated compared to the history of IPO underpricing of the country for the past 10 years. It debuted at a 7% underpricing. Now, 2 possible explanations. Number 1, most people in China don't know anything about the Agricultural Bank of China, which is nonsense. It's the equivalent of one of our 4 major banks with a customer base larger than the population of the US. So it can't be that it's an unknown company. So what is the alternative explanation? The alternative explanation is that the investment sentiment, especially specifically with the Chinese banking industry, is not that good. Now, if you have a copy of last Friday's financial review, you know that the China's banking regulators, they are asking for a second round of stress testing on their banks, assuming not a 30% scenario of property price plunge in major cities. That's a few months ago. Last Friday's article is about a redo of their stress test, assuming a 60% plunge in their property prices. So that's what's happening here. All the things are bubbling. I don't want to sound like Dr. Doom, like my PhD supervisor, but all the sentiments that I'm seeing with China and Australia is actually all the symptoms that US and Ireland are actually showing before they actually collapse. So this is not saying that you should go and short sell shares. I mean, that has already begun, I think. But you know, it's not all nice and rosy. All the symptoms are starting to come up, actually. But whether or not the symptoms are there, whether or not you believe it or not, we still have to take the exam. So let's continue with this here, okay? But these are just some of the things that I could share with you other than things from textbook, okay? Now, so underpricing is a very, you try to have all this explanation for why is it underpriced. So what I'm trying to offer you in the next 2 slides, and then after that we'll take a break, is something that I feel is a bit more logical. It has a bit more fundamental structure to it than some of the things that are being preached in the textbook. So you see, there's significant pricing uncertainty because you see the company has no track record. Okay, it's not a publicly listed company, so most investors wouldn't know what this company is about. And that's why the underwriter is very important. It's not just the insurer against the risk that you may not raise the amount of capital you need. The underwriter does the whole work, from marketing, sales pitch, promotion. Do you want to subscribe to this? This is a good company, etc., etc. And then in the end, if it's not fully subscribed, okay, I'll take up the rest of it. Okay, so it's the whole works. That's the intimate relationship between the underwriter and the entrepreneur. And part of the reason is because of this information asymmetry between the entrepreneur and potential shareholders. So the underwriter steps in to try to signal, to say something good about the company, to try to get shareholders to buy shares, to participate, to subscribe in this IPO. Okay, so that's the That's the relationship between the entrepreneur, the underwriter, and also new potential shareholders. Okay, the underwriter tries to reduce that information asymmetry between the two parties concerned. What has that got to do with underpricing? Now, one of the explanations, the most common explanation in most textbooks about underpricing is this very sexy phrase that they call winner's curse. They say, wow, winner's curse, what is it all about? Now you see, if you, in the market, there are two types of investors, okay? So that's how the story goes. You have informed investors, you have uninformed investors. Now imagine, with uninformed investors, if you are actually able to successfully subscribe to shares in this IPO, it must be the case that those who are able to get it, the more informed investors or those with the connections, they don't really want to participate in this IPO. That's why you actually manage to get your hands on it as an uninformed retail investors with no special connections. The fact that you're able to lay your hands, that you are able to win some IPO shares, it means that nobody else wants them. That's why you're able to get it. So that's the so-called winner's curse in the context of IPO. So what the explanation tries to build, that is being built up, is to say, okay, we need some degree of underpricing to make sure that those uninformed investors are not being ripped off so that they would also participate in our IPO. So we need some underpricing to attract uninformed investors to make sure that even if they participate and lose out, they don't actually lose out financially. They still have some money left on the table for them to feel good about themselves. So this is the winner's curse argument as to why there needs to be a certain level of underpricing to attract both informed and uninformed investors. Now say what you might about the validity of that story, but to me it's half-baked, because you see, I can't go into the details why it's half-baked, because you see, if I'm an investor, what it's saying to me is that as a semi-informed or retail investor, the best thing for me to do is to subscribe to IPOs. If it's a good IPO, I'll never get it, so I don't have to worry about it. If it's a bad IPO, I manage to get it, what must be the thing that I immediately do? Anyone? If it's indeed the case that I will only get shares if it's not a good company, and I end up getting it, winner's curse. What it's saying is that the only sensible thing for me to do is to immediately sell my shares, which defeat the whole purpose of me being an investor in the first place. I would rather be a day trader then. So this is a paradox argument, which is why I never liked this argument, but then again it was invented more than 30 years ago, still here in all the textbooks. So I'll try to share with you something that I think is a bit more sensible. We'll try to get some sense of it, and then we'll take a break. Okay? Now, this is where the underwriter's role is important. You see, it's not just the insurer to say that, okay, you fall short of 20 million, I'll take up the rest of the shares, you take all the money you need and then run your projects. That's important. I mean, to be able to fund all positive NPV projects that you plan to fund, that's important. But you see, what I think is more important from the new company's perspective is to make sure that the initial public offering is a success. Because you see, the IPO is not the end, it is just the beginning. If all things go well, you're going to have subsequent issues, whether it is rights issue, private placement, dividend reinvestment plan, whatever, okay? But the IPO is only the beginning. And what you want to make sure in the beginning is that your IPO is fully subscribed. Because if it's not fully subscribed, you would always be remembered as, this company wants to raise a private placement. Isn't that the company that's half floated? Only 60% subscription. Only 60% of its shares managed to get subscribed. So you do not want the investment public, whether it is existing or new shareholders, to remember you as the IPO that wasn't fully subscribed. So full subscription is very important, even beyond the fact that whether or not you really need the money or not. You do not want to have this memory of being a partial success or partial subscription. You want the memory to go down as full subscription. So that is very important. Now, what has that got to do with the underwriter then? You've got a few investment banks that you can go to. But what you want is to go to an investment bank which has an unblemished a picture-perfect track record in terms of underwriting. You want to go to the underwriter and you want to say to the underwriter, would you please put your brand name on my prospectus? Why? Because if the underwriter puts his or her brand name, the investment bank's brand name on your prospectus, what is that going to say to the potential new shareholders? And it's going to say that if this underwriter backs this IPO must be a good IPO, because the underwriter will not back this IPO and risk his own track record. So in the IPO process, the underwriter's reputation is very important. Now, if assuming that out of 10 underwriting investment banks, if I'm the one with the best track record, and if you come to me and say, could you please put your brand name on my prospectus, other than charging you ridiculous underwriting fee, what is the one other thing that I'll be thinking of that I would actually, shall we say, force you to do? Force as in a quotation, okay, not really force you, but what is the one thing that when it comes down to negotiating the fine details, the one thing that I need you to do before we have this, before we sign the contract and be partners in crime? What is the one thing that I'll be afraid of for the current IPO that I'm considering as the underwriter?
Wouldn't it be rather possible that the underwriter, who is also responsible for putting the shares on the market, that they could price them so low that it's not fully priced, they have to, then the underwriter buys the shares, but because the underwriter being sort of responsible for, pricing for a less suggesting price, the underwriter gets the execution of the shares for a very low price.
You're treading close to the water of conflict of interest, because you're supposed to act on bona fide on behalf of it. Yeah, I mean, that argument is not there, so what, but one of the things that I'll be concerned with whether or not I put my brand name down on your prospectus is that if this is not a successful float, not only do you have make a bad debut, my unblemished track record would also be detrimentally affected. So you see, I as an underwriter is not just the risk that I need to subscribe to the shares that nobody else wants. It is also the risk that if this is not successful, my track record would be contaminated as a result. So it is risky for me as well as the underwriter. And if I'm very reputable, the reputation risk to me is very high as well. So if you think through that process, if you're the underwriter, what is the one thing that you'd like to do with the entrepreneur? Let's take this simple example. If both of you are in agreement, we got all these things, the fair value of your company, I think you should be able to sell your shares or float your shares at $10. $10 seems like a fair value. Even if this is an agreement between the entrepreneur and the underwriter could actually say, okay, $10, but I would like you to consider accepting $8.60. Why? If it's floated at $8.60 and if the fair value is anywhere within the range of $10, if this IPO is being floated at $8.60, it will attract a lot of investors to it, because as far as they are concerned, this offer price is very low compared to a fair value of $10. So you see, the underwriter's reputation allows him to say to the customer, even though I believe that it's worth $10, I'd like you to consider taking just $8.60 per share from the table, not $10.
So why is it such a big puzzle? Surely everyone's trying to be conservative and make sure that the IPO is overpriced. Everyone wants to be risk averse, be conservative. Why is it such a crazy, unexplainable puzzle that the IPO is consistently underpriced?
What I'm offering you is one plausible story, but you forgot the question, is this plausible story empirically supported? That's a totally different thing. It may make sense, but if the data doesn't support it, then what you said doesn't really matter. Okay? So if I may continue with my story first. So you see, from the entrepreneur's perspective, even if we say that, $10 you want me to accept $8.60, why wouldn't the entrepreneur just walk out and say, this is a ridiculous deal, I'm not going to accept this, this is a rip-off. You agree that this is $10, why $8.60? Why would private company owners tolerate this amount of discounting then? Because if I do not tolerate this, I have to go next door. Because the best underwriter is then going to say, okay, you can just go next door. And you're going to then increase the risk that it will not be a successful float. So you see, the IPO is just the beginning, not the end. So if I then say, okay, I'm willing to tolerate $8.60 instead of $10, I do this business once off with you because the IPO is just once off, then if you can guarantee me a successful, fully subscribed IPO, then for subsequent issues, I may be able to then raise funds at more favorable prices, given a successful, fully subscribed IPO. So that's why, even if it's worth $10, I may consider accepting $8.60 just for you to put your brand name on my prospectus. So that's an explanation of both that it is underpriced and why this underpricing actually persists. Because if you think about it, as time passes, as underwriters build up their reputation, they got more bargaining power and they're going to demand more underpricing. So underpricing doesn't just stay stable, it could actually increase over time. So that to me is a more plausible story than to say, oh, we need some underpricing to attract the uninformed investors because they're winners cursed and things like that. Okay, so this is a story that is more convincing, I think. Whether or not it's really supported is a different issue. Okay, so journal articles are not part of the reading pack, so you don't have to worry about that. But I'm offering you something that is not written in most textbooks. Okay. Okay, we'll take 10 minutes and then we'll start to look a bit on the mechanics of option contracts. Okay, I'll see you in 10 minutes.
I think you have uttered in the class, I'm not quite sure about the puzzle. what is it, and even in the class, I guess you have spoken about, ask your tutor about it, right? I don't know what is the kind of contradiction between but I simply in the class you have answered this, why it is like this, because it's like they do what no, just
That's okay.
that's
If you use market offer price and total price.
okay.
So if it's, you can see that those two numbers can be two sources. So sometimes if people really get it wrong, but if it's just
Market price and offer.
honest mistake, maybe it's an honest mistake, then we know that sometimes okay it's mispriced because one is too low, or sometimes it's too high. Either one is too low, the other one is too high.
These both, prices, market prices of price, they do add up
If you look at these two numbers,
this
you
is
know that if they don't align, you have an error. But if it's just honest mistake, what is your feeling in terms of the errors of one IPO to the next IPO to the next IPO for thousands and thousands and thousands of dollars? What can you say about the nature of those misalignments? Sometimes it's positive, sometimes it's
according to you, it should not be misaligned. It should not be misaligned. There is a chance that
For
can happen.
a given case, it will always be misaligned.
It's always
But across different cases, sometimes the misalignment is positive, sometimes it's negative. Can you see that?
sometimes it's positive, sometimes negative due to the numbers. Sometimes it is more.
Sometimes we may set the
This
offer
is
price
more
too low, sometimes we set the
low,
offer price too
sometimes
high.
positive, and then it is more than it is negative. Obviously.
Yeah. But
both the
if that's the case, if you add up across thousands and thousands of IPOs,
Yeah.
then
They don't
the
add up to
numbers
zero.
should be very small.
Should be very small, but you have said they don't add up to zero. Have we written this down?
Yeah, the underpricing part is because it is not very small,
It is not very small.
but it should be.
It should be small.
Okay, let's look at the concept. You understand why it should be small? Sometimes it's over, sometimes it's under, but they wash out. So you can see that.
Wash out, so means it should be small.
Very small number.
Very small number, close to zero, not zero.
Yeah, but the empirical evidence is
Empirical
it's
evidence
not
says it is not zero.
close to zero.
It should be zero, but it is not close to zero. Okay.
That's why it's a problem.
I don't know, like I was seeing question, I thought, oh, I didn't put it. Anyways, thanks a lot.
The important thing is to see why it should, and if it's meant to be misvaluations or mistakes here and there, then over a large sample, those mistakes, plus and minus, cancel out.
Yes, I was thinking.
But it is a property. It doesn't, it is systematically skewed, and it persists, it doesn't disappear. That's why it's a property.
Thank you very much.
Yeah, extensions in these silos. How are you with that? Because forming in a play like the whole last week is on new 159 actor. Until we get those appears. Very relaxed few days later. Was the week okay? Was it 2 months? Yeah, still Monday. I'll be able to see how it goes. Okay. Yeah, start of the year. The only reason I ask is, the only reason I ask is, it's very, very good to see extensions. Maybe I'm speaking from the past. It's just turned out badly. The whole week I'm forming my play. I will email you, but I'll see how it goes this weekend. Thanks very much. Yes, I was actually agreeing with you. I am.
Yeah, so have you heard of any other explanations before, or what are the...
Everyone says it's not very well understood. For me, I think the whole explanation is just about risk aversion. Because I think that we keep feeling with investors that when huge time comes and when the right people start placing, then that investor's more happy to provide money to you. This is that sales quote. I think it affects the reputation of you as a bank. So if the company is lower hardware sales and equipment sales, it doesn't produce the issue high. I think that the reputation of the bank stuff is healthier now. As you can see from the Q2 to Q3 figures, now companies didn't want to go public because naturally
that is unique now is really my fault.
It's all your fault, and this CDS Plus, open work is that there's more types of ways of pricing. And you have the option to buy that at a profit.
I think it's more locally, I think it's a bit more
Right, let's restart the workshop. Like I said before, the last third of today's workshop is really to set you up for next week, which is where we look at hybrid securities, which is will be the last category of capital funding sources for a company to issue not equity, not debt, but something in between. Okay, so that's hybrid securities. So this is one way of looking at it is to say that okay, it possesses characteristics of both debt and equity. But you see, normally what also happens is that the mechanism that triggers the transformation from debt to equity or transform into new equity, etc., is some sort of option feature. Okay, so it's the option feature that transforms, for example, a bond to new shares, or from a derivative to new shares, etc., etc. Okay, so options is the mechanism that's being used to, is being intertwined with this hybrid security section, which is why it's important to know a bit about what actually are options, the basic mechanics of it. Okay, I just want a quick show of hand. How many of you have absolutely no idea? If I phrase it that way, nobody will raise your hand, but I'll still phrase it. How many of you have very little idea on options? You've only heard of the word before, but you don't really know what it's about. So all of you have done something on options. So that is something that, okay, so that is what I'll try to assume. Now, you may know the basic mechanics, but not in terms of the pricing. That's okay. We just need the basic mechanics of it, okay? So so that's what we'll do for the rest of today's class, and then next week we'll look at how it's being used as part of a hybrid security type of package, okay? So basic definitions, option contract gives buyer/holder, so a lot of the initial learning of option is to do with the terminology. So the buyer is sometimes called the holder of an option contract. Okay, so buyer and holder, the right but not the obligation to undertake a transaction in the underlying asset for a predetermined price, and the price is always represented with X at some pre-specified date in the future, maturity date, capital T. Okay, so that's the key definition of an option contract to the holder or the buyer. Now, there's two types of options, and they reflect the different types of transactions involved. With call options, the transaction is a buy transaction. Okay, so you can buy the underlying asset. With put option, it's a sell transaction. So you sell the underlying asset. Okay, so call options is buy, put option is sell. There's another distinction, but we won't worry about this for our class. European and American option has something to do with the ability of you, for the holder to actually use it. With European option, you can only use it at that pre-specified date. With American option, you can use it at any point in time in the lead up to that pre-specified date, etc., etc. Okay. And the last term to note is the value of the underlying asset. So we use S capital T as the notation for that. Okay. So this is the basic definition of what an option contract is. Now, from this one single definition, you can imagine that the first thing to keep in mind in terms of getting a first hand into options is to know the various scenarios, the various specific positions. Now, with this with this slide, you should know that you'll be able to know that there's at least 4 basic positions. An option is a contract. On one hand, I've defined it for the buyer, holder, buyer, etc., etc. Now, a contract is always between at least 2 parties. So if there's a buyer or holder on one side, there has to be somebody else on the other side of the contract. And the person on the other side is called, if it's a buyer, the other person will be seller, so buyer and seller. Now, if we use the option language holder, then the equivalent language for the counterparty is the writer. Okay, so option holder and writer, option buyer and seller. You can use them whichever one you want to use, but keep in mind that an option is a contract between 2 parties. Okay, it's between 2 parties. Now, with this slide, you know that, okay, if it's 2 contracts, a call and a put and 2 parties, you have 4 basic positions. Call, put, holder, writer. So this gives you the intersection of 4 positions. Holder of a call, holder of a put, writer of a call, writer of a put. So those are the 4 basic option positions. In any class that teach you option, the first thing they'll teach you is to recognize those 4 positions. Okay? The holder of a call, holder of a put, the writer of a call, and the writer of a put option. Now, the best way to summarize those 4 positions is in this standard table. Okay, and this gives us a sense of the payoff as well. We'll just focus on the very first line. Okay, so if you can see one of the 4 positions, you see, the way to learn options is actually much simpler than you think. If you can see long in the call option, the buyer of a call, it's quite easy for you to flip it around and see the seller of a call. Because the buyer and seller are 2 sides of the same contract. So if you can see things from the buyer side, you should be able to see things from the seller side, because it's just 2 opposite parties of the same contract. Okay? So that's one way of extending from long in the call to short in the call. Long means buy, short means sell. And those are the interchangeable terminology. Okay? If you can see buy in the call, you should be able to see sell in the call as well. Okay? So that's one way of expanding from one position to the next position. Now, and between the 2 sets of positions for call versus put option, now we know that call options are to do with buy. Now, the opposite of buy is sell. So if you can see the pair of positions for call option, you can then take those 2, flip it around, and see the 2 corresponding positions for put options. Because going from call to put is switching from buy to sell. Okay? So long in the call, we can get short in the call, and then flip, flip, flip. But that's one thing, but for us it's just very basic mechanics of it. Okay. Now, what are the 2 scenarios, and what do these 2 things mean? You see, option is a contract to buy something, to transact in the underlying asset for a predetermined price. Now, the predetermined price is X, it's a fixed number, it doesn't change. What is the unknown value is ST, is the worth or the value of the underlying asset at maturity date. Because you see, if you're the buyer, if you're the holder of an option contract, you have to make a decision. Do I use it? Do I exercise my right to either buy or sell? And what guides you in your decision is the price that you're able to transact at versus the worth of it at that point in time, which is the difference between S and ST and X. See? So those are the 2 numbers that you would want to compare to make a decision of, do I use it or not? Okay, so that's the setup. Now with a call option, and because one of the number is an unknown, but the other number is fixed. So there's only 2 columns to take care of everything. Because if the fixed number is 10 and the other number is an unknown, we don't really know what the worth of the underlying asset is going to be at maturity date. But the way to describe it is to say, okay, it's either above It's either larger than, it's either equal, or it's smaller than. Those are the only possible scenarios. So in these two columns, I've taken care of all the scenarios. Either the unknown value is larger than the fixed number, or it is less than or equal to the fixed number. So by doing that, I've taken care of all possibilities. So it's either larger, equal, or smaller than. Okay, so those are the three possibilities then. If I'm the buyer of a call option, my ability is to buy. I have the right but not the obligation to buy something for a fixed price. So if you've forgotten most of what you learned on option, the easiest thing is to throw in some numbers. If I have the right but not the obligation to buy something for $10, I would only use it, or put differently, it would only make sense to me if the actual underlying asset is worth more than $10 in the market. Say for example 12. If it's worth 12 in the market, if I have the ability to buy it for 10, that's where the option makes sense to me. That's where I would actually use it, to buy it at 10 when it's actually worth 12 in the market. It does not make sense for me to be able to buy at 10 and for the actual asset to be traded at $7 in the market. If it's worth $7 in the market, I will not want to use this contract. I will not even want to touch this contract to buy it for 10. I would simply, if I really like it, I would simply buy it for 7 directly in the market. I wouldn't use this contract. I would just buy it directly in the market for 7. Okay? So you see, that's why this column is saying that if the fixed number, if 10, in this case 10, is greater than the worth of the asset, you would walk away from this option. You would not use it. You would let it expire. You wouldn't touch it. Which means that as far as this option contract is concerned, as far as this call option contract is concerned, the payoff that is actually giving to you is simply 0, because you're not using it. So that's why the payoff is 0. If you use it, you would only use it if it's worth a while. If you can buy something for 10 when it's actually worth 12. And so how do we represent the benefit that goes to you when you actually use the option? Simply 12 minus 10. So, or in general, ST minus X, which will be a positive number, corresponding to this scenario. Okay, so that's the easiest way that I can, easiest discussion on what an option contract entails from the point of view of the buyer, the holder, etc., etc. Okay, so that's one thing. Okay, so at the very minimum, you should be able to follow this through. Okay, so either nothing happens, or from the holder's perspective, either nothing happens, but if something was to happen, it will be a positive cash flow. It cannot be negative. I will not do something that would cause me to have a negative cash flow, because I have the right but not the obligation to do it. Okay. Now, if you see the all this basic argument from the buyer of a call options perspective, you can easily flip it around to look at that the point of view from the writer, from the seller's perspective. Given the scenario that the holder doesn't do anything to the contract, okay, I just leave it on the table, I don't touch it. So if nothing happens for the holder, then automatically nothing happens for the writer as well. So for both parties, nothing happens. So that is why you have 0 and 0 here. Okay, so if nothing happens to the holder, nothing happens to the writer. Very easy. Now, if something happens to the holder, in other words, if the holder decides to say, buy it for 10, it's worth 12, I would use it. I have the right but not the obligation to buy it for 10. So the payoff is ST minus X for the call option. This payoff, the cash flow of a call option, if it's used, the payoff will always be ST minus X. And this expression goes to the buyer. It's positive ST minus X. Okay. If this was to occur for the call option, it will be positive, because the call holder decides to do this. So it's positive to the call holder. What about to the call holder, the call buyer? Okay. What about from the seller, from the writer's perspective? Well, this is the same cash flow that is received by the holder or the buyer. It must come from the counterparty. So the payoff that flows to the holder must come from the writer. So what is the payoff to the writer then? This is always the payoff of the call option. The holder receives it. So the writer must pay it. If the writer must pay this payoff, then all I need to do is simply put a negative sign in front. Okay? Now you would have heard of this, okay, the two parties of a financial contract have a zero-sum game relationship. That's actually what's happening here. 0 plus 0 gives you 0. Positive st minus x plus negative st minus x gives you 0 as well. Okay, so it's a zero-sum game. But that's basically what's happening here with call option. Okay, so either nothing happens or something happens. Now, if you have a look at this, the payoff of a call holder that I've given you in your formula sheet, it has it as the expression for it as a bit more than what I've said here. We know that, okay, either I get 0 or I get some positive number. But you see, at time t equals 0, which is now, I do not really know what's going to happen in the future. I know that it's either nothing or something. So to generalize the expression for what I'm going to get as the payoff for the holder or the buyer of a call option, either I get nothing or I get some positive number. So the way to summarize those two scenarios is to say, I would get the maximum of either 0 or some positive number. So if st minus x in terms of the actual situation is, if it's 7 minus 10, we know that it's negative 3, but the holder would choose to do nothing. If it's nothing, it's actually 0. Okay? So that's why if it's a maximum of, if this is negative, the holder would actually choose to take 0. Okay? So as a general expression, it's the maximum of st minus x or 0. Now, if I were to ask you to write out what is the payoff to the call writer, so in other words, I'm only asking for the mirror image. That's all, just a mirror image. What would that expression be? If the holder gets 0, the writer gets 0. Okay, so that's one situation. If the holder receives positive st minus x, the writer pays st minus x. So from the writer's perspective, what are the two possible scenarios? It's either 0 or some negative number, some negative cash flow. So how do I write the general expression there? I know that one of the things I could get is 0. The other thing that I could also get is actually st minus x. Well, st minus x is the benefit that always goes to the holder. So from the writer's perspective, I have to actually pay st minus x. In other words, minus. So either I experience nothing or I have to pay something. So what would be the word in front of it? Very good. Okay, minimum, that's all. It's either nothing or some negative number. So the minimum of either 0 or some negative number. Okay, so that's for the call seller or call writer's perspective. Okay. Now, if you've only done very basic options in your previous courses, then one of the things that you could also that may help you, in getting a hang of all this for next week's class is actually the following. Now, if I were to say something about, okay, let's say we're in a world of call options. Okay, we're trying to get a picture, plotting payoffs against the value of the underlying asset at terminal date t. If I were to draw a diagram to illustrate the two sets of scenarios here, what would the diagram look like? The easiest way to teach entry-level students about options is the following. We divide this space into two parts and ask ourselves which is the part that makes that makes the option exciting. Sorry, which is the part that which is the part corresponding to the case where nothing happens. Now they say you know that it's either left or right. It's one or the other. Which is the part where nothing happens? I'm glad you asked that question. Doesn't really matter because whatever happens to one happens to the other as well. There are two parties of the same contract. I'm asking which is the part that corresponds to nothing happening to the contract itself. Yeah. This side. Because you see on this side, the holder is not going to do anything. Back to this example. 7, the x is 10. If I put in some numbers and say that this is 10, then 7 is less than 10, which means that the holder is going to walk away. I'm not going to use this contract. I can buy it directly for 7. So this is the part where nothing happens. So in your diagram, this is simply flat. Okay? Nothing happens. But then you would also know that, oh, okay, on the right side, the option is going to generate a payoff because it gives the ability to buy something for 10. If it's worth $12 in the market, the payoff of this contract is 2. The larger the value of ST, the larger the payoff. 12 minus 10, 15 minus 10, 20 minus 10, etc., etc. So what would a graph look like? It's not just outward sloping. The slope is actually 1, and it's a 45-degree angle because the increase is proportionate. Every dollar increase in the value of the underlying asset increases my payoff by $1. Okay? So if this goes from 12 to 13, the payoff goes from 2 to 3. So it's a very proportionate increase. So that's why it's the slope is 1. Okay? This is meant to be 45-degree, but doesn't really matter. Okay? So this is from the perspective of the call holder. And once we see this, again, I reiterate my point. Learning option is about taking one position and mapping out to other positions. If you can see, this is, if you can accept that this is reasonable, and it's quite easy to see for a call holder. I'll better write it here, okay? Call holder, buyer, use whatever you want, okay? Then the corresponding picture for the call seller, for the call writer is simply, anyone? It would have this axis as the mirror image. So it is still here, flat on the left side, but on the other side, it would actually go downwards. Okay? So one's gain is the other's loss. But when you add those two graphs together, you get a horizontal line along the zero axis. Okay? Call seller, call writer, use your own word. Okay? So I've gone through in a bit of detail on something that all of you have done before, the basic mechanics of not just a call option from the holder's perspective, but I've also tried to map it around to look at it from the writer's perspective. Okay? Now if I were to then ask you to try to relate to the second one, which is same thought process of holder and writer, but the only difference is we're moving from call option to put option. So everything you're thinking in terms of buy now becomes sell. You would also see that, okay, that's why all the terms are shifting around. Have been swapped. The S and X have been swapped around. Okay? X becomes the positive number. Let's if you have a look at this expression, the reason why X becomes a positive number is because put options gives the holder the right but not the obligation to sell for a predetermined price. When you sell something, you receive X. So it's a positive cash flow. That's why X is at the front. Okay? And what you're giving up is just the value of the underlying asset. Okay? So everything that we discuss with call option gets switched around from buy to sell. Okay? But it's the same type of discussion flows on. The holder would only do something to the put option if it's worth his or her while. If I have the ability to sell something for $10, if it's worth $25 in the market, I would never touch this asset. I would never touch this put option. I would simply sell the underlying asset directly for $25. I wouldn't use this put option at all. But if the underlying asset is only worth $2.80, I can sell it for $10. It's a very good put option contract to me because I can sell something for $10. It's only worth $2.80. Okay? So that's simply saying that 10 minus 2.8 is greater than 0. Okay, so that's long in the put option. And again, the same story applies. If it's a positive cash flow to the holder of the put option, it's a negative cash flow to the writer of the put option. Okay? So if it's 0 to 1 to one party, it is also 0 to the other party. If it's positive cash flow to one party, then it is that same expression. All we need to do is put a negative sign in front of it. Okay? So from this expression, you can see that, okay, from a put holder's perspective, either I get nothing, which is 0, or I get something. If I get something, the positive payoff is x minus st. So to cover all bases, the expression is the maximum of either 0 or some positive payoff. Okay, so it's the maximum of x minus st or 0. Now if I were to use the same routine to ask you what's the expression for the payoff of the put option writer, this time you should be able to do it much easier, right? You know that, okay, from the writer's perspective, if the holder doesn't use it, nothing happens to me, so it's 0. But if the holder of the put option actually use it, he gets a payoff which is x minus st. Now the payoff is positive to the holder, but that payoff comes from me. I have to pay the payoff. So to me, this expression is actually negative. So either nothing happens to me, or if something were to happen to me as the writer of the put option, it's a negative cash flow. So in general, the expression that applies to me is simply minimum. The minimum of minus x minus st or 0. Okay? So this is the put writer's perspective. Okay? So again, all these things are two sides of the same coin, whether it is holder writer or whether you look at it for a buy scenario versus a sell scenario. Okay, things just get flipped around. But this is the most basic of the mechanics that we need to go through. Now, in terms of the actual pricing, this is not something that I would require you to do. Option pricing is actually something that I've taught for the past 7 years. That's why I say it's not suitable to teach that in 2 or 3 hours. I need at least 18 hours to teach you properly option pricing. Okay, so that's why we have to look at the more practical part of it. Okay. Now, warrants. So once you know a bit about options, I can talk about all this in terms of the sources of capital. One of these sources of capital from a company's perspective is to issue these things called warrants. Now, warrants are very similar to what we've discussed in terms of call options, with one very crucial difference. If you exercise, see, call options or exchange traded call options, they are written on underlying assets which are existing shares. So they are written on existing shares of the company that are traded in the stock market. But with warrants, they are actually written on new shares or unissued shares of the company. So in other words, if the holder of warrants choose to exercise them to buy shares at a predetermined price, he or she actually buy new shares, not existing shares. Okay, so you actually buy new shares that are created and issued by the company. Okay, so warrants lead to the creation of new shares as opposed to existing shares, which is why with warrants, there's this implication for dilution as well, because you would only exercise warrants to buy new shares if the price that you pay for those warrants, the exercise price, is less than what those shares are worth in the market. So in other words, you're paying the company an amount that's less than what they're currently worth. You're paying X, which is less than ST. That's why if you do it, share price will fall, for the same reason with rights issue, the same reason with private placements. Okay, so that's the story with warrants there. And let's do a quick exercise to get a good feel for what actually happens when warrants are exercised. Same routine. What is the before issue share price, or before the warrants are being issued? The worth of the company, a very simple gold mining firm, 1,000 ounces of gold, current gold price is 1,300 ounce. So the worth of the asset of the company is 1.3 million. Okay, so it's 1.3 million, which is 1,300 times 1,000 ounces of gold. assuming it has only shares, okay, there's no debt on issue. So 9,000 shares, so the value of the company is simply 1.3 million divided by 9K. And the answer to that is simply 144.44. Okay, so that's the first thing. Now, when the company issued the warrants, so let's assume the scenario that 1,000 warrants are being issued for free, so the company doesn't take in anything with the issue of the warrants. Each warrant, if it's exercised, it creates one new shares, but you have to pay $120 to buy that one new share. Okay? So if all the warrants are being exercised, what actually happened is you raise an amount of money, which is $120 multiplied by 1,000 new shares that will be exercised. So it's 120K, and you divide by 9 plus 1K. So it's 10,000 shares at the bottom, because it's 9,000 existing plus 1,000 new shares. And at the top is 1.3 million plus $120 per share. That's the exercise price. And there's 1,000 warrants being exercised for 120K. And this must be a number that is less than 144.44. Okay? So it's about 142. So the dilution as a result of the exercise of the warrants is about $2.44, going from 144.44 to 142. Okay. Now, as a finishing note, the dilution would actually be slightly less than 2.44. In other words, the number here should actually, more realistically, it should be a number that's slightly higher than 142. And the reason is simply because in this simplistic example, the warrants are actually being issued for free. So you imagine if you issue warrants and you got some price for the warrants themselves, that adds to the numerator cash flow. Okay, so that's something to keep in mind, that realistically the dilution is a bit less than this, because we didn't just get money from the exercise price when they are exercised, we also get in money when we issue those warrants at a price. Okay, those warrants are worth something. And just as quick to finish off the purpose of warrants, warrants are very important, and I think this is a nice way to tie in with what we did on what I discussed on projects that have 2 stages and things like that. So if you issue with a project that involves 2 stages, you do not want to raise too much capital in the upfront, because you don't really know whether you need all the money, because it's contingent on you striking oil or an R&D project becomes successful. So that's why with warrants, it allows you to raise a small amount of money when you sell those warrants. And then if the project is indeed successful after the first 3 to 5 years, then people will be interested. They'll have a lot of incentive to exercise those warrants, and then they pay a larger sum, which is X, later on. So the issue of warrants allow you to raise funds in 2 stages, which suits a lot of the industries where projects are described by 2 stages. The initial smaller stage, plus a later stage where you've got full-scale production. Okay, so that's how warrants tie in with copper mine projects and excavation projects and R&D type projects. Okay, I'll see you next week when we go into hybrid securities. Okay, thank you.
I think the loss should bear by the call holder, not the call writer. Yes. If you buy a call when the market price is lower than the fixed price, buy an option, price is lower than the X, the fixed price, and then there will be a loss. You bear should bear by the call holder, not the call seller. All right.
Sorry, I don't understand your question.
There's some notes you write. I think it's not this one. Here, this one. I think this should be the holder, not the writer. Right?
But see, the writer is always see, from the writer's perspective, either nothing happens, either nothing happens. If something actually happens, it will be a negative cash flow. Basically, this one is from the writer side, and then the one is from the holder. This one. Can you say this one is from the holder? Yeah, this one is small. Long is from the holder, right?
Still don't understand.
But can you see that as the option seller, there's only two things that are possible. Either nothing happens, or if something were to happen, it will be negative.
Why negative? Because I sell the option, I will get the profit when
No,
the
I'm talking about the payoff at maturity date.
whether the payoff is gain from you sell an option. Is it payoff?
Try not to think of the price of the option itself. Forget about that part. Just focus on what will actually happen at maturity date.
Sorry, the majority?
So two things are possible. Either it's used to or it's not used to. You see that? Those are the two possible scenarios.
Okay, one more question. The put seller, is it equals to the call seller? Put writer? Is it equals to the call writer? No? Different?
Because call and put are two different contracts.
Okay.
So when you play, those are two different contracts. Those are two different contracts.
So I understand. Okay. I saw this here is a call right, not the put right. So.
Oh, that's what you were asking.
Yes.
You were trying to.
I
First thing to
understand.
see is to see you pick either a call or just pick one, and then try to look at the buyer and seller.
Yes.
Look at the two, and then once you're comfortable with them, do the same thing for the other option. Then you'll be less.
Thank you.
This is you for the underwriting. Isn't it possible can be higher than the closing date or the offer price?
Can the offer price be higher than the first?
The closing date can be, and that's called the offer
That will be overpricing.
the overpricing, and then what happened to the market? See the company get the profit or
Okay, so you're asking along those lines.
yeah.
Well, first of all, just to clarify first, this IPO underpricing and all those numbers that I put in,
Yes.
they do not mean that every single IPO it will be underpriced. They just say that the cross-sectional average is underpriced, but there could be a few that are overpriced.
So just like the one you
So it
saying.
doesn't mean that the stock IPOs will not be overpriced.
Yeah. So if you take that like for Australia it's flat to something like I think I meant to be the Commonwealth Bank is over about 7%. Is it bad?
What it's trying to say is that this is not a good thing because it's being underpriced at the lower end. So it's not, it's only mildly underpriced. Normally when you think about it, you might say that, oh, those maybe are the companies that are undervalued, that the marketing, the promotion that he done is not that good, etc. But specifically, he wanted to go
But if higher than that, what is it?
It is higher than that, and I think that actually happened to David Jones, where the first day, where it's actually overpriced instead of
Overpriced, yeah.
Now, again, with that, I guess the simplest explanation is to say, oh, we really overestimated ourselves
So
in
basically,
terms of the
good
overprice.
when is the offer price is lower than the one is good is if the offer price is lower than
I wouldn't say whether it's
no.
good or bad, because you see, it's very tricky, because if you
Yeah, I know
look
that.
at, if you look at it, it's like a very simple definition. See, this, the sign of this, whether plus or minus, which translates to under or over, is dependent on two numbers that are determined by two different sources.
Okay.
So whether, see, if it's underpriced, it could be that we set is too low, or it could be that for that particular day, the market overall did very well.
But isn't if that the offer price is too higher and then means it become underpriced, right? If that one is too high. If that one is higher,
If this is higher,
yeah, that
say
will be
this is
the
10,
underpriced.
and if this is 8,
Yep.
if this is 10 and this is 8, it's actually over.